Well, good morning, folks. How are you? It is a good morning. So, get this rubbish off my platform here. It's going to zero anyway. So, we're looking at the NASDAQ. Ready then. Let's get in here and take a look at what's good. All right. So, we have a lot of annotations on here that I don't want to have at the moment. All right. So, we have the daily chart. NASDAQ. I will cover dollar index, euro dollar, pound dollar, crude oil, gold, silver, and ES in concert with this. And then I'll give you my views on the matters that began over the last few hours or whatnot as it pertains to the Middle East. And then I will send you on your way. I have a lot of things I have to take care of today. Pop, duty, and all that stuff. So I found a small window of time to throw this in here today. So just, for the folks that want to have this kind of stuff, just know that I wasn't planning it. I just happened to have it. I know a group of you in your community come together after live streams and whatnot, and I will be listening, but I can't promise that I'll be able to answer your questions. So, just as a note, don't be offended if I don't pop on there and start talking to you, but I will be listening. So, anyway, you can catch up with those folks and me sitting in attendance with ICT_concepts on Twitter. Good morning, Kit. All right, so we are looking at the daily chart, and we talked about this volume imbalance. I'd mentioned that this high here, if it took that, I'd have to reconsider whether or not my bearish stance on NASDAQ is warranted. And you can go back and check me on that. The idea of seeing it run there and then give up the ghost like it did there, problematic. Now, how much of an opening range gap lower do we get on Sunday tomorrow at 6 p.m. Eastern time? That's actually pertains to how much of a degree of severity we see, over the weekend with the bombing campaigns and the exchanges between the two. I think that it's warranting. I mean, they put an aircraft carrier right there next to where missiles could just. Well, we were off a little bit, and we just happened to strike the Gerald Ford, and then that gives us a whole lot more response leverage, I guess, in the public eye. So it's just a whole lot of theater over there, folks. And I'm not going to go into it as I would if we were on X Space, but you already know what my thoughts are on this. It's all cool. So I still believe that we're going lower, and that nothing's changed. Nothing's bullish on stocks. Nothing is really promoting the idea that people feel safe buying companies right now with the expectations they're going to go higher. Too much uncertainty, too much concern, too much fear, and now add that to the equation. We're doing the bidding of a little place over there in the Middle East, and it's just going to be a problem. It's going to be a problem everywhere, and it's going to bleed out, and we're going to feel it. So it's not fear. It's just I want you to be aware of it, and it's causing heaviness, in my opinion, on stock index futures because stocks themselves should not really see a whole lot of interest. People are going to pull back their interest in it. Okay. So because of that, you need to be careful listening to who you listen to on the internet, because there's going to be a lot of folks out there that are just going to be like, I'm expecting it to do this or that. Just be careful. Okay. We have a lot of gap risk now. And if you're in a position, if you're in a position rather, you don't have the luxury to be able to manage that at this moment. If we don't get a big gap on Sunday, it might be a consideration on your part to lighten perhaps your holdings. That way it reduces your risk. Right. So anyway, I covered several specific lows on the live stream I did yesterday. I shared on X um, the parts that people pretend don't exist in my live streams where I'm actually calling things before it happens. Um, I mentioned in the live stream that I am bearish. So my preferred long-term macro perspective is bearish on NQ. And I'm looking at this right here as the first half of the year objective. So in other words, think of July 4th. Okay. Now, obviously, it can get down there sooner than that. Or it could say, I'm not going down there at all and go higher and prove me incorrect. And that's okay. But given all the things that are in play right now, both technically, the fact that we took this high out, it gave up the ghost rather quickly. Um, we're still just inside of a larger consolidation. Nothing really has changed except for on the very small time frame, which is again one of the benefits of why I'm teaching you micro market structure in sub 1 minute time frames. Because while many of you might look at this and say, I ain't touching that, that would be a sober perspective, a good perspective to hold if you're expecting short-term trading or swing trading on higher time frames. It's going to be very reluctant to see setups pan out because of the general nature of what it's doing. It's basically being held captive in a range. So with that, we'll add the annotations back and we'll go into the lower time frames. Just know that this big, large rectangle here, when I was adding all these the other day, I wasn't concerning myself with making sure what time frames they're visible and whatnot. So it just so happens they appear everywhere, and that's why you have this, okay? So this wick now we have created, that's going to be germane to Sunday, Monday, Tuesday, Wednesday, Thursday, Friday's trading. Okay, so just make sure that you grade this entire discount wick and have those levels on your chart. Okay, they aren't going to exist on mine because that's not what we're measuring here. You'll see what I am measuring when we get down to the lower time frames. So with that, just know that here's a swing low that on the downside, should we get a gap lower opening and it just works lower and trades below Friday's low, I would be expecting that as the near term target, which is the 23rd of February, last Monday's low. And then the next one would be the consequent encroachment of this wick, which is halfway, and a close below that would indicate that we're probably going to take out that low. And if it's going to take that low, this is reasonable to anticipate as an extreme. And then how we trade, if at all, below that low warrants whether or not we see speed and magnitude getting down to the objective I mentioned as my first half of the year objective on NASDAQ's downside target. All right, so let's go into a 15-minute time frame. Take a look at that, a bellwether time frame. And we have, again, just be mindful that these annotations are going to be cluttered up because I just throw it together to throw a short little vignette on X this morning. So it's one of those things. It wouldn't be in there if it was a pre-recorded video. I'd have all the time to take all that stuff out and make it pristine. But we're doing it down and dirty because I don't have much time to talk to you today. So look at all this. Okay, look at this price action here because this is exactly what I'm trying to communicate to you. Inside that range of gray space highlighted, this is high resistance liquidity run conditions. Okay, this is a 15-minute time frame. If you don't know what this is doing, or if you look at this and you think, wow, this is a bull flag, you're going to get murdered. If you look at this and think that, oh, yeah, it's going to be real easy for me to get in there and trade on a 1 minute chart, you're going to get cooked. These are the identifications of a market that I teach you as students to not try to push too hard. Study it. So that way you learn to identify what it looks like, what it's likely to continue doing, and appreciate the reluctancy on the part of price going to your targets or presenting very easy low-hanging fruit objectives for entry to exit. So in other words, that's what high resistance means. It's resisting your ability to find efficient, low risk trades. That's the definition for it. Okay. So when we see price leave these areas and start moving into a more efficient to inefficient, meaning small little consolidation, then an inefficiency forms, then we see it trade back down into that inefficiency and then make a higher high. This is low resistance liquidity run conditions by comparison to this area that's shaded in gray. Okay. The word key resistance, okay, or the keyword rather, resistance in high resistance liquidity run conditions doesn't imply at all support or resistance. It just means that it's resisting the efficiency of trading in market conditions that are not being held captive, where every candlestick or range shares the previous range of the candle before it. So it's basically a big block of nonsense. Okay. It's very, very difficult to navigate that if you're brand new. Now, it's not impossible, but even for people that know how to trade well, it can be very frustrating. So, doesn't it make more sense for you if you're trying to learn how to quickly identify when these conditions are in play and simply don't touch it? Treat it like a rattlesnake. It's probably going to bite you. If it bites you, it's going to hurt. And you may have anaphylactic shock and die. So, look at it that way. Okay. So, now with that out of the way, a little bit of business, I got a bunch of comments in the videos saying, can you tell me what you mean by high resistance liquidity run conditions? And that's a visual representation of it, okay? This is low resistance liquidity run conditions. Why? Because it has inefficiencies like this gap, this inefficiency here, that wick, this inefficiency here, the inefficiency here, trades up into institutional order flow entry drill with a order block, change in state of delivery, moves lower, leaves little gaps like that. That is low resistance liquidity run conditions. Why? Because it's affording you to see inefficiency exist, retrades to it, and then expands lower again, or in deference if it moves higher. It just allows you to see porous price action, little gaps, inefficiencies where there needs to be patchwork. Patchwork is simply going back into those areas where one single candlestick, regardless of what time frame you're looking at, needs to have another touch by price. Now, it may be a partial touch like it does here, where this candlestick's wick just goes above the previous candle's high inside of this civvy. That's an institutional order flow entry drill. When we see these form and price starts to run, then we can be comforted knowing that we're not in high resistance liquidity run conditions. And therefore, as long as everything in order flow is suggesting it's conducive for a continuation, it means that all up close candles when you're bearish are repelling price lower, and old down close candles get eaten into and just completely consumed. So that is a proper view without having to have any kind of gimmicks, no footprint, no level 2, no level 3, no nothing like that. You don't need anything like that. You're simply just looking at price action. Okay. And when you blend a concept that I actually learned from Larry Williams, because this stuff isn't Larry Williams, the idea of small ranges, like this one in here and this one here. See how small these little candles are? If we're bearish and we're expecting lower prices and we're seeing a low resistance liquidity run condition, that means there's inefficiencies there. As soon as we enter small ranges like that, what's going to happen next? There's a cycle in the marketplace that Larry Williams talked about. He's the first one to talk about it, where it goes from large ranges to small ranges, large ranges to small ranges. Okay. That is a precursor to large ranges. Small retracement while inside that SIBI, we go to a small candle again. What's coming next? Large ranges. What's the bias? Bearish. We're in low resistance liquidity run conditions. That means it should have no problem expanding lower and targeting the short-term low, which is there. And then once it does that, we want to see it do what? What signature would we be looking for? In my case, because my candlesticks are black for down close and green for up close, I want to see stretched out black limousines. Long, down close candles. Expansion in the range size, protraction in the direction being bearish, and leaving porous price action in the back part of the run. Leaving that there. Why? Because that is indicating breakaway, continuation gaps, measuring gaps. It's telling you something. The market's weak. Okay, so by contrast, you can see that we've now covered the relationships, or I guess disparity between the two, being high resistance liquidity run conditions versus low resistance liquidity run conditions. All right, so we have, where are we at here? That pink or red area up here, that was that volume imbalance on the daily chart. And let me just take you back just for a second so that way we can calibrate everybody's perspective. That is this little inefficiency between the two candlestick bodies. The wicks are actually overcoming that range. So this candlestick's closed, this candlestick's open. That's what I'm highlighting there. Okay, so that's a volume imbalance. Whenever we see these, okay, you want to have them annotated because they're gonna trade back and forth through them. Now notice that on this time frame where it formed, we traveled up here with the wick and then closed down here. Now it's formed. Me personally, I would not use this any longer or have any concern for it if the daily chart lays a body down over top of the entire range. So in other words, a body would have to look like this. And it doesn't matter if it's up or down close. Once it completely lays over top the lowest point and the highest point, then I'm no longer, me personally, I'm not concerned about using it anymore. That does not mean that it can't use it and that it won't use it. I'm just saying that I'm not going to key off of a new entry or use it as a target. I may use it for stop management in a position, but I'm not going to take it as a new entry or a terminus because now it's been neutralized in terms of the importance in my perspective of it. It does not mean that it can't be used or the levels that are gradient levels inside of it because it's on a daily chart. The range is significant enough to allow for that. It simply means that I'm not personally using it with the highest degree of importance placed upon it. Whereas if this doesn't occur while it stays a volume imbalance with no subsequent candle at a later time laying an entire body up or down across the entire range of that volume imbalance, that being this candlestick's closed and this candlestick's opening, it has to bridge both those two prices with the body. Once it does that, I'm no longer interested in. Okay, so there's another question I got a lot of this week. You're talking too much, bro. Well, I'm not answering your question. I'm answering other people's questions. So let's go back down. We'll go into a 1 minute chart now. I'm sipping some orange juice in case you hear me slurping. It's not intentional. I can't edit that stuff out. We're live. I'm cheating today because I'm going on KD tomorrow, killer diet. I'm going back to next to no carbs. And I made myself some French toast with brioche bread today. It was sinful, actually. But I'm going to have the sugar crash later, and then I'm going to have to eat high protein the rest of the day. All right, so let's go into the... Dude, nobody cares about what you eat, man. Here is the morning session. Here's 8:30. And we had PPI yesterday. And because, you know, the administration we have right now and what we've had for the last 10, 12 years, it's pretty much trash. It's garbage. And you can't trust the data. You can't trust them. And it's a mess. There's this timing aspect to the economic calendar, but we're really not seeing the delivery that you can expect. I mean, I'm always expecting red folder events to be volatile. Okay. But PPI just didn't really do it for me on Friday. I was kind of expecting it to do a little bit more than it did, and it just really didn't pan out much. So, and again, I don't ever look at the data on those reports. I'm just using them as a, you ever watch a football game or a sports event or a movie, or you're watching a rom-com because your wife has forced you to watch it and you've probably seen it 17 times, but because Reese Witherspoon's in it, you have to endure it. I mean, I can relate. Sweet Home Alabama, please never have to see it again. But anyway, You're watching it, right? And all of a sudden, this boop breaks in. We interrupt your program to bring you an important announcement. And then it's not as important as you thought it would have been for it to interrupt your show. Well, I use the economic calendar like that. It's going to be an interruption. It's going to be an interruption to your trading week, your trading day, and it's probably going to be an uneventful thing. But what's different? If they open up a TV program interruption and it's wartime related where you live, then it's obviously a red folder event that means something to you. If it's a interruption that, hey, look, around the world on another continent, somebody's doing something to somebody else, well, it's easy to be like, well, come on, man, you interrupted my show for that. And that's kind of like we're experiencing right now. We're seeing reports coming out that aren't really delivering with the weight that they normally would. And the reason why is because participation's low right now. And low participation does not inspire them to spool price too far because there's not enough size to warrant filling those numbers. Meaning, we're going to speak hypothetically for a second, okay? Let's assume and let's pretend that there's an algorithm, and that algorithm's role is to start running price higher, and it doesn't matter how many people are buying and selling. It's just going to keep offering market price higher, 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 because dealers are not market makers. Those guys down there on the stock exchange floor, they're not market makers. They're dealers, they're traders. That's it. They don't make price. They can't control price. They'd have no control over the mechanism of higher highs being delivered in price delivery. That means it doesn't matter how many people are coming in and selling, all you want. And the price just keeps going higher and higher and higher. That is the mechanism I'm talking about. It's an engine. It's a facilitator. It is a autonomous auctioneer. That's what it is. Okay. Because participation is low, they can dial that measure of expansion way back and small. So instead of trying to run 800, 900 handles in an extreme fashion, when there isn't that much in terms of playing counterparty to, the liquidity is not as high as it would be in other times. Right now, there's a whole lot of uncertainty. There's a whole lot of concern, deep pockets, big money. Look at Warren Buffett. They're all retreating back. They're not exposing their money to high risk. But what does everybody in retail want to do? I got to get 20 accounts in my prop firm. I got to over leverage because, I got to get my money real quick. And you're burning through accounts where rich people, wealthy people are saying, there's nothing for me to do right now. I'm going to wait because they know what's coming. Trouble. And why are they going to risk their money? They're not going to just throw it out there just to say I'm a big wig trader. They're preserving their wealth. So they have pulled back when all the retail world is still trying to get out here and do lots of trading in an environment that is not conducive for it. So because the algorithm, if you believe in that fairy tale, knows that there is no participation in a grand scheme of volume, participation in open interest, the actual contracts exchanged, they're very small in comparison to what would normally be around this time of year. Second week of February, it usually starts to vault up and we get a whole lot more participation. And we haven't really seen that yet. But as soon as we get out of this daily range that we're in on indices, you're going to see a whole lot of fun trading because it'll finally be like everybody can finally breathe. We're all breathing stale air right now, gasping, waiting for, that window or door to open up and a big rush of fresh air come in. And that's going to bring all kinds of wonderful setups. And it'll be fast, easy running markets. And maybe you'll get 1 or 2 days or 1 or 2 sessions out of a week where it's like, I got beat up because it was reluctant to go anywhere. And that'll be high resistance liquidity run conditions. And it'll do that until we get around the summer months. And then we'll get into more of what we're seeing right now. And maybe 1 or 2 days that'll be low resistance, but predominantly it'll be tough. Unless there's a whole lot of things geopolitically going on and that'll drive the markets all over the place. And then we enter another period of time where it's low resistance liquidity run conditions, and that's in the fall months. usually the last 2 weeks at the earliest of August, or at the beginning of September, all the way through till I guess the first week of December, second week of December, and then the holiday break usually brings us back to 50-50 type trading. I don't care about the Santa Claus rally stuff because I don't care about that stuff. I want to be around the holidays with my family, so that's why I stop early. But that's usually the general rules, how I perceive the marketplace over the yearly range. I spend a lot of time measuring risk in the first month or two by not participating. Second Tuesday or first Tuesday of February, I'll go in and I'll slowly start dabbling to see what kind of market we're getting. I'll get a measurement of the tone of the marketplace. Do my orders come in real easy? Is there a lot of movement in price action? Am I feeling connected? Am I in sync with price action? Or am I going in and I don't feel like I'm connected to the marketplace? It's high resistance or it's short lived in price runs and targets that would be met easily. They're not being met easily. So that means we're probably still beginning to now come out of that beginning of the year funk where it's the accumulation phase of the yearly candle. But when we get closer to March, like you're going to see a definite difference in the coming weeks because we're in the third month of the year. The first 2 months of the year is out of the way. And now because we have what's going on over the Middle East, all the things happening in, a group of emails that people are talking about, all those things are having reverberations across the globe. And that's causing shakeup. And shakeup's going to cause people to do what? Pull away from risk or add risk because of the drama and chaos. And we're also going into the springtime months where that will also impact crops. So for commodities and commodity pricing, all these factors come together. And then because we have what's going on over the Middle East, you have the tendency to anticipate higher prices in energies like crude oil. And if it intensifies over there, that's certainly going to be a catalyst for higher prices in crude oil. And if it gets really, really bad, we could see $150, $200 barrel crude oil. But that's assuming, the severity and a prolonged campaign. That's unfortunate if it happens, but that's kind of really what they want. But that's another discussion for another platform. During the live stream I gave yesterday, I talked about when we were down here. I said this gap would become an inversion fair value gap if we traded through it, and we got that over here when we entered the macro time, 950. I said if it were to trade above that, we would likely run above and take that liquidity out there. And I mentioned that this looks a little too smooth. And what did I mean by that? Because as I watched that little portion to make sure I cropped out that part for the X space, not the X space, the Twitter or X post that I made, where I highlighted the very specific moment at 32 minutes and 20 seconds in that live stream on Friday, the 27th of 2026. You'll see that little bit being done. And I was a live stream. And I'm not trying to make too much of a small thing, but I want you to know that once you know what you're doing, you'll be able to use my concepts that are not rebranded. Find somebody that talks about that, and then that at that time. Nobody's talking about that. Okay. Wyckoff, no. Nope, didn't happen. But I would counsel you to think about what that was showcasing. It was showcasing visibility. It was showcasing dynamics in price action that is not secured by studying anything else in retail. Nothing in order flow, nothing in volume profile, nothing in Elliott wave, nothing in any other thing. Whatever you want to talk about. It may be somebody else's hodgepodge of retail concepts brought together and automated and called it an algorithm. You may look at something and say, well, I'm looking at classic chart patterns, or I'm looking at moving average crossovers, or I'm looking at point and figure. Whatever it is you think moves the marketplace, none of that told you that this portion of range right there is going to turn into a long to take out that liquidity during a 20-minute window period that I talked about, that some of my students don't believe exist, which is the macro time. It's impossible for me to do what I told you in that live stream yesterday if that was not true. So these are the reasons why I have fun with all you that are, you take shots at me and we can spar back and forth because it's fun. Because to me, I'm wondering to myself, and I talk to my kids all the time, like, how are they digesting what it is I'm saying before it happens? Like, either I'm really, really lucky, and this is not ego, folks. I'm just saying we're having fun here. Either I'm having a great deal of luck, highly specific luck, or it's hindsight and it's a pre-recorded video I'm talking over top of, which is going to be impossible because I did it on a live stream with thousands of people watching. And by the way, if you watched it live and you didn't watch it in a recording, let me know on Twitter. Let me know. I saw that live. Um, the idea of it being somebody else's logic, it's laughable. And if it exists anywhere else, somebody else could say, here's where Wyckoff taught that this little area right here is going to be a long, and it'll run to that liquidity right there, and it's going to occur between 9:50 and 10:10 Eastern time. I'll pay you $5 million if you can find it in Wyckoff logic where it does that. 5 million US dollars, real money. I'll even hand deliver it to you. You can live stream it. And I'll even kiss your ass on live stream. That's how sure I am. Okay. That's how sure I am. But I do this because it's fun. Because I'm pushing individuals into a internal wrestling match where they have to consider either one, I'm a time traveler, I control price, I'm the market maker, or my concepts work and forget everything else and just learn to use them efficiently and correctly with good risk management. And let's see what happens in your own hands. And that's what I've always stated. I want to see what you do with it. It doesn't matter if you believe I'm the best in the world. Doesn't matter if you believe that I could walk out there and win the Robbins Cup in a week. I could care less what any of you think. I'm placing these things in your hands and I'm asking you, what can you do with them? And once you're able to make money with them consistently, should that happen, I want to know what you're doing with it. Not that I'm entitled to know what your finances are, but are you out there just trying to get a lot of attention buying stupid stuff? Junk cars that are overpriced and nobody cares about right away as soon as you get them. Oh, look at him. Oh, look at her. You're going to see, it feels good while you're driving it, but you're going to find yourself looking around at red lights. Who's looking at me? Get your bigger glasses out. Cover your face up a little bit more with your big sunglasses. Who else is looking at me? Because then you have to tap in like a vampire, a clout vampire. Try to see if people look at you and smile and gawk because you have something. And that's not what success is. Success is not needing to do that because you're content. I don't need to go out there and drive around in my sports cars. I don't need to go down to the warehouse and pull out something I ain't drove in 6 months. I don't need to do that. I know I have it. It's there if I want it. And I don't care what anybody else thinks about it. And that's what your trading needs to be. Like, it needs to be motivated on that premise that you're here because you want to make money. You're here to trade good setups, not simply because you are an action hound. You need to know what you're looking for. And I showcased that on the live stream yesterday. I kind of reminded you all that I am bearish. I am bearish. Okay. But I told you this would lead to this. Okay. And we were talking about before the opening bell, during the opening range, we know that we're looking for what? The first presented fair value gap. We have that here. See that? Let me tick this off just for a second, okay? So that right there is your first presented fair value gap. It forms at 932. It can't be 930. 931, there is no fair value gap. 932, it creates the candle number 2. And as soon as this candlestick closed right there, you have a verifiable range to now incorporate in your chart. Now let's add it back. So now think for a moment. It's Friday. We have bearish stance, or let me speak in my own perspective. Okay, I'm bearish. We've already seen it sell off in the last 2 days after taking that short-term high out in the daily chart. Just for sake of completeness, we had this run up here on Wednesday, midweek, took out that little short-term high. I said it could trade up there. It could trade up there. And then how it trades there, I'll have to determine whether or not if my bearish stance is still viable or not. I said that in analysis. I said that. I said it in Trader Roundup when I was questioned about this wick and how these candlesticks were. Yeah, it could go up there and hit that. And I will have to see if, if that bearishness is still warranted there. But look what it did. It hit there. And then we opened up at 6 o'clock and then gave up the ghost immediately. And this was all on the heels of a NVIDIA earnings. And NVIDIA earnings, many times I've seen lately, they pump it, but it can't hold those gains. It gives it back. So it's becoming a Judas swing. So that you do with that with what you will. So we didn't see any follow through that. Once it just hit it, boom, and now we're back in here. So, but now we're on Friday. So by having Friday and the characteristics and things that we usually see on a Friday is what? TGIF. What if TGIF, which is, thank God it's Friday, where it usually goes back 20 to 30% of the weekly range? What happens if it's a consolidation week? What's it likely to do? Pull back to the middle of the range. 40% mark from the highest high down to the lowest low. 40% of that is a retracement, higher if it's moved lower in the most recent candlesticks. In other words, Wednesday, Thursday, or Friday, or Thursday, Friday, or just Friday. If it's done that much of a run, it can retrace back and consume 40% of the weekly range and go back to the middle of the range. Why 40, not 30, not 20? Because it's consolidation. So it can be a little bit more exaggerated getting back to the middle or the median. Okay, so that's where weekly profiles come in. I know you're getting all this stuff for free. Man, I'm such a guy. This guy ICT, I'm telling you, man, you're so cool, ICT. He didn't even charge me anything. Isn't that wonderful? I'm stealing a sip. It's actually really good orange juice, or it's maybe because I haven't been drinking it for almost a year now. But the first presented fair value gap, let's go back to narrative. It's Friday. It presents it. People see this as this is a shift in market structure. It's time to go long. Wrong. Why? What's this? My stuff out of the way here. We have sell side liquidity right there. Relative equal lows, too clean, too perfect. Even though that first presented fair value gap is there, even though we had this short-term high taken out here, what's the long-term bias? Bearish. These lows here, if the market's going to go higher on TGIF, consolidation week, it's going to pull back 40% level of the weekly range. That's the minimum, by the way. This right here, what's the extreme, you're probably asking? Well, if that's the minimum, what's the extreme? 60% of the range. So you better be writing this stuff down, folks. Don't wait for the books, because I'm telling it to you right now. I told you, everything's going to be on the YouTube channel. The book is just simply going to put it in a way where you can go right to the information, and here it is. Well, that's it. I'm not going to watch your videos. Okay, do it that way then. But you still won't get the dynamic of having it shown to you over charts, because I can only rather talk about it in one example in the book. If I put the amount of examples or theory in play in action, I'd have a whole book, 350 pages or more, with just one conceptual idea, and never really still scratch the surface of how that would be implemented in other things. You see how vast this is? So you still have to come back to this compendium to get a further treatment of it. This is the encyclopedia of ICT, this YouTube channel. But the book is just simply going to be a way for you to say, okay, how can I go in and use this information right now based on zero understanding and how I can then relate to the YouTube channel. There it is. So that's kind of like what they're going to hopefully accomplish. And I may not be successful in it because I'm not really. I've never really wrote a book, that would be a baseline to evaluate that. But I mean, a whole lot of audiobooks, right, with all these videos and such. So they took the sell side here. Now, bring in the factor of TGIF during consolidation week. It doesn't matter what the bias is. We're going into a weekend. What are we anticipating right now? What climate are we in? Black swan, something big, something geopolitical is coming. We have all that military hardware over there in the Middle East. You know what was coming. You've been expecting it for months now. You've been really expecting it in the last few weeks. And then when Yahoo come over here and visited right away and then hurried up and went back home, that was like the green light that they were going to be doing this weekend. There's no point in talking about it. Everybody kind of expected it. So what? Uncertainty. So nobody wants to be in a position. So they're not going to sink the market crazily lower. They're not going to rally the market crazily higher. What benefit is there for the algorithm to do that? There won't be enough participants to lay down a groundwork for a future run. So they're just going to go back into the middle of the range for the week for Friday and just let the cards play out on Sunday's opening. How much of an intensity do we see over in the Middle East, and what response do we have? Is it just localized there, or do we start seeing things pop off over here in the States? So that's what we're blending things that we have no control over. You might think that I don't care about that. It has nothing to do with me. I'm in a peaceful part of the world. Okay. But if you're trading in the financial markets, you have to be aware of this because it's going to impact us as traders. It has an impact in sentiment. It has an impact on the money flow. It has an impact on risk, and also the severity and degree of volatility. And those are factors that I can't, and I've struggled with 2 chapters to try to and I'm not satisfied. Like I'm reluctant to include them in volume 2 and 3 because they don't do a good enough. Let's say it this way: as a writer, I'm not capable of communicating in a way where even when I read it, I'm satisfied by it, and I know what I'm talking about regarding it, and I still can't communicate it effectively. Where I know if a reader reads it, they'll feel, I know what he means by that, and that's useful. So those are 2 chapters that may not actually be in there, but they'll be in lots of rants, and they have been in lots of rants. Some people disagree with what I say in the rants pertaining to geopolitical things. Other people say, wow, you're right on the money, and I want to hear more of it. But I still don't feel satisfied in the actual text written format of it. And so they may not actually appear in the books. So just know that that's why we have Twitter Spaces, and that's why we have these boring parts in the videos where it doesn't feel like it means anything to you. It's useful to you. But over time, as you mature as a trader, you'll see that these things actually are important and they are impactful to your trading, whether you are in any peaceful part of the world or whether you're ground zero right there in the Middle East. So the market takes the liquidity out. Once it does that, then we can anticipate the market wanting to use the first presented fair value gap. So what does it have to do? It has to trade through it and come back down and operate just like what? An inversion fair value gap. But is it inversion? No. It's reclaimed. What is the concept of reclaiming it? And he's teaching today. Good grief. I feel like I'm back in school now, man. When we get a smoke break? So we have a buy side and balance, sell side efficiency, BISI. Liquidity is taken there. And we trade up and through it. And now what do we have? We have a trade back down to consequent encroachment. What is it not allowed to do once it does that? What does it do to validate you getting long? Whether it be an inversion fair value gap. In other words, if this was a down close candle, a SIBI, when price goes back above it, that would be inversion. It's not inverted. This is inversion. It's changing its character from that of what would normally be bullish but it moved through it here. Then we ride above it. Once it leaves it like this range becomes reclaimed. If this was a down close candle, it would be an inversion fair value gap. So up close candles, when we trade up to them, after trading down through them, we have to rely on time and patience to take us up above it. And then once it does that, we want to see it respect the upper half. Can it lay a candlestick wick down in here and even poke one tick or maybe two ticks below it? Yes. If it does, while that candle's forming, we have to wait and see, does that body get right back in the upper half? You can't risk trading in this environment that we're in right now doing that. In high resistance liquidity run conditions, don't trade like that. In low resistance liquidity run conditions, I am doing that 90% of the time. I'm scaling in, I'm adding, and I'll add one more. If it pokes its head outside the bottom end of it and I'm bullish, in low resistance liquidity conditions, I will still buy that because I know what I'm in. I know what I'm looking for. But in high resistance liquidity run conditions, the likelihood of you being profitable doing that because of the volatility being so high right now, it falls far lower in the odds in your favor doing so. So don't do that. So how do you combat that? What I'm showing you here, you can do this in both high or low resistance liquidity run conditions, which is this. Buy side and balance, sell side efficiency is your first percent to fair value gap. It's TGIF. You're expecting higher prices. We haven't even got to the open range yet, but we have sell side here taken there, and the market will still seek to get to this if we can get back above that orange inversion fair value gap I told you before 9 o'clock yesterday morning. Before 9 o'clock in the morning, I was telling you about that right there. We're down here. I said it can go up to that, and if it goes above it, then it may act as a run or a discount array to get to this liquidity. But you just don't do it simply because, oh, well, here we are. Let's go long there. No, it has to do what I'm describing over here. This is the part that many of my students, when they watch a video or two, or they make the mistake of going to other people's content where they've taken little bits out of my actual lectures, and they think, well, I got a market here. I'll just take the small pieces of the stuff that's no rant, and I'll just say, here's the part where he's talking about this fair value gap. This is the part where he talks about the Reaper. This is the part where he talks about, the Gauntlet. This is the part he talks about, whatever. And you think you're doing something cute, and you're advertising for me, and that's great. You're going to get some YouTube video kickback off of it, and that's wonderful. But I'm getting more publicity, so you're working, and you're getting paid by YouTube. I'm not paying you, but you're not actually learning when you go there to get that content like that. You're getting familiarized with something, so that way you can say, well, yeah, that's not interesting to me. Let me go to this part here. Let me look at a silver bullet. Let me look at the first bits of fair value gap. Let me look at this model, that model. And then what actually happens is then you start going into a pursuit of finding where there's more information about that. So where are you left to go? Back to my YouTube channel. So, you might as well just dig in and start somewhere. And where you want to start is now. Whatever I'm doing now, work your way backwards. That's the best way. That's always the best way. Don't ask me anymore. That's the best way. Because what I'm teaching right now is in the trenches. It's real time over real time price action. I'm doing it live. My son's using a live account so you can see how it grows. What else do you want, folks? I'm not going to put you in trades. Okay, I'm not going to tell you when to buy and sell it. I'm not going to put you in a stop loss. I'm not going to manage your position for you. I'm not going to tell you nothing like that. I'm never going to do those types of things. I'm not licensed to do so. I don't want the risk involved. I don't want the emotional tug of war it's going to cause. And when you make mistakes, I don't want to know about it because you did it on your own and you can't blame me for it. You see how I've made this perfect little hedge around me where you have the responsibility, as it should be as a trader. But as soon as I or anyone else tells you, this is what I think you should do with your trades, or this is what I think you should do with your money, you have a perfect excuse why you lost. But you'll claim that you did it when you win. And what is that really doing? It's gearing your mentality around the wrong things. You're building suspicion around you being able to do this in your own hands, in doubt. And you're solidifying that all the time by constantly being tethered to me if I were to do that, and I never will, or anyone else that's doing it. You're tethering yourself to someone else's capability, and you don't know if they're going to be able to do it. And I can tell you this, they don't know if they can do it either. They're just hoping you're going to be a sucker long enough to keep paying them. That's the reality of it all, folks. Because I'm going to be real honest with you, okay? And some of you, as my students, are going to be mad at me, but you know this is the truth, and I have to be consistent about it. If you're able to make millions of dollars in your own hands, okay, the 90% of your presence online shouldn't be trying to sell something. It should be you showing, if you're going to show anything. And there's no better sales pitch than you proving, here's what I'm making with real money. Bang. It just, it screams, it literally screams, if you're doing so well, why are you selling? So, as my students that do these types of things, maybe the rest of this year and going forward, you should start to transition a little bit to results that are very respectable, and let that answer the question. Because I get it all the time, folks. I get questions all the time. What do you think about your students doing this and this and this and this? It's none of my business. It's really none of your business unless you're paying them. But once you pay them, then it is your business, because you want to know if you're being a good steward spending the money on these people, telling you that they're going to do something for you. So there's a lot of things that you have to have the responsibility over. And the first thing is, are you taking trades that you yourself have found, that you've done the work and trusting it? And when we see first presented fair value gap, there's logic that has to be implemented. Just simply because it exists in the chart. Oh, there it is. It's a fair value gap. So now I know what I'm going to do, right? It's going to go up, and then they're going to say, look at this. It's going to go down. And why did it fail and went down here? Because you left smooth edges inside of what? The opening range. That first 30 minutes, it can go all over the place. You have to wait until everything is in alignment for that narrative that you're expecting to be there. Now, let's roll this back for a second to what I was saying about this fair value gap here, and how this fair value gap, if it went above it, would run for that liquidity. Let's say we did this. And I think I earned the right to be able to talk hypothetically at this, right? We have these relative equal lows. Let's say that as soon as the first presented fair value gap formed, let's say that this low had taken that low out there. If it would have done that, in other words, this low went lower than that one, soon as this shift in market structure there occurred, once that occurred, any retracement back down in that first presented fair value gap would be a viable long. But you can't take that as a long if these relative equal lows are there and we're in the first 30 minutes of trading, because the opening range is not 15 minutes. Everybody ran the orb. I'm an orb trader. Orbs, baby. ORB. Orbs breakout trader. Oh man. 30 minutes, folks. Okay. 30 minutes. That's what the algorithms do. That's what all of the large institutions factor, that 30 minutes. Okay. I know you don't believe me, but compare it. Look at your Mickey Mouse 15 minutes. Okay. And then look at the full 30 minutes. I've even got into the first hours of trading. The first 60-minute trading is going to, again, give you much more information, and you're going to find a whole lot more clarity and continuity in your setups and your short-term to swing trades using that. We're going to segue into that in March. So, but you have to know the mechanics of how to use the opening range and also the first presented fair value gap. So we talked about narrative. We talked about the effects of the weekly profile. They left these relative equal lows here. If this would have done something like this, where if it would have ran up, didn't come back down like this. So in other words, say it created this low, it ran up, created the first presented fair value gap here, and just kept on going and took that liquidity out there. What would I have done differently? And what would I have done to trade it? I would have waited for the price to come back down into this gap, and then I would have treated this as inversion fair value gap. So in other words, I was expecting it, or would be expecting it rather, the market could trade down below it and then come back up and hit midpoint or fail to get in there, I'd be scaling in shorts here and take first partial here and let runners reach for lower prices. Why? Because it took this initially right away, but it didn't do that. It left this here, created the first persistent fair value gap, dove down, knocked out anyone that wants to go long. And why would the market go up there? Why would it want to go to this liquidity? I told you before 9 o'clock, it was likely to use this to go up to there. Why is this viable? You see this little pink line with the number next to it right there? What do you think that is? I'm going to maximize this chart because I don't want you looking over here at these things. Not because there's something over here I'm trying to hide, but I want your full attention on this time frame. Pay attention, young Padawan. Here is regular trading hour settlement price for Thursday at 4:14 p.m. If we go to regular trading hours, that's this right here. Okay, so you have 4:14 p.m. Eastern time. Make sure your charts are always toggled to New York local time. And then we were opening up down here. At before 9 o'clock rather, we were down in here. And I pulled up that range that you can't see because there's no electronic data showing. It's only going to show you the closing price on regular trading hours at 4:14 p.m. Eastern time. And then it'll start populating the regular trading hours at the 9:30 a.m. time. So the open on this candlestick is here, right there. And let me show you. I'll toggle. And there's a screenshot. You can take a screenshot of that and you'll get the levels for the Fibonacci in case you guys are talking. Can you please show me your Fib settings? There it is. I heard you. Chapstick. So there's the open to the close. So we were down here before 9 o'clock while we were doing the live stream yesterday. And I was just simply running some numbers, looking at it, just visually looking at it. I'm at my dining room table, sitting here. I'm not up in my office where I have all my hardware in front of me, all my computers. Well, screens. I only have one computer. But the perspective is just simply over a laptop. And I was doing it with the live stream yesterday. And based on where we were trading at around that time, I said, okay, well, I know this price was on my chart and it's up here. So around the 50% mark, which would be mid gap, consequent encroachment, that's that level right there. Okay, watch. I'll highlight that with purple, and I'll darken it up. Okay, you see it right here? Now I'll change it green. See it? That's consequent encroachment or midpoint of the range between where we opened at 9:30 and the closing price at 4:14 p.m. Eastern time. 4:14 p.m. That's the last tick you're going to see when regular trading hours stops. Trading still continues, but you have to monitor it through electronic trading hours. So that's all of from here to 9:30 there. So all of this is electronic trading hours. Tradable, but to see the gap, which is the regular trading hours opening range gap, you have to go back to 4:14 p.m. Eastern time and then wait for 9:30's first print. As soon as that happens, you drop a line on it and you annotate it. So what I did here was I measured watching price action with you in the live stream where I was simply looking at this. We had a chart basically naked, and I'm looking at price action with you, saying, okay, you see how we made a lower low, lower low, lower low. Okay, and see this little gap right here before it did this little gap here. And I look back over here and I said, price is a little too smooth here. I think that, if price can get above this gap here, once it trades above it, it could act as an inversion and take the liquidity out right there. Why did I pick this level there? Well, let's go back to what was already known. 4:14 p.m. Eastern time on Thursday, that was the settlement price, regular trading hours high or low. Well, we're down here at 840. What's the chances of the market going all the way up here and going higher than that before 930? Very low. So this is opening range gap high based on what? Regular trading hours using 4:14 p.m. You can use the settlement price at 5 p.m. Eastern time. You can create a opening range gap with that price too. I taught this last year. It's in the lectures, okay? And just like toggling on the daily chart, setting the settlement to on or off, it gives you a disparity between where the volume imbalances may or may not exist in the chart. I look for the setting that shows the close proximity volume imbalances. I want to know where they are because the market's going to use them. And I think in the last couple of years now, we're talking about them. You can see there's a usefulness to it that didn't exist in anybody else's work. But I picked this high because where we were trading here, I just simply looked over here to the right on the price axis and said, okay, visually, I can see we're here to here. Half of that would be in this general area. So what structure in price action aligns with that for liquidity purposes? It's this high. That looks a little too clean. Why? Because it just so happens to be agreeing with consequent encroachment, which is 70% likely that it's going to trade there between 9:30 and 10 o'clock in the morning. Here's 10 o'clock in the morning. Here's the candlestick high. I was off by 2 minutes. It's failure. It's fraud. It's a scam. Don't listen to me. It's up to you whether you decide there's any validity to it, okay? But the point is, the logic was we have to anticipate this occurring on the simple basis that we have this big discount gap opening at 9:30, which is right there on that price. So if it's opening here below where we settled over here, this in and of itself tells us it's gonna likely explore that gap. Highest probability is it's gonna go half gap. There's gonna be days where it doesn't even go there. There's gonna be days where it just opens at the 9:30 opening price and just straight drops or straight goes up higher. But I'm talking about probabilities, statistical probabilities within the context of a narrative. Just like I taught 70% of the time, Tuesday London session in Forex pairs creates the high of the week when we are bearish. When we're bullish for the week, it creates the low of the week. And if it doesn't do it on the Tuesday, it will do it on the Wednesday. That was the rules. There's people out there trying to crunch numbers. Bro, I'm taking the data back to so-and-so. You're not looking at the context of every individual week. None of you are doing that. So you can come out with all your Mickey Mouse reports and say, this is what the real truth is, and ICT's a liar. ICT lived it. So you're looking in the past without all the details, without all the things being there and pertinent. I broke it down real time beforehand, and I kept data on all those things. So yeah, it's a difference. There's a difference between trading the markets then and talking about what you can run in a report. That's output that you didn't participate in. You didn't do those things. I did it. I lived it. Okay. I'm not making up bullshit. Okay. I walked it. I lived it. I'm teaching it. Other people are learning how to do it. And it's repeatable. And I'm teaching you to get your own information. Start accumulating the information. You have the unique opportunity in your journal to keep that every single week. This was the probability for the market to be bullish or bearish based on what you have in hindsight because you're learning. But then over time, you're going to transition to what you anticipate the market's going to do for the week beforehand. And then you're going to see the power in what I'm teaching you. And too many people want to talk like they're, the gotcha. Oh, we're going to expose or I'm going to improve upon something. No, you're not. You're not going to improve shit. Okay. You're diluting it. You want some kind of a co-sign, like you're a co-author or some shit around here. You ain't co-signing nothing. Okay. There is no co-signing line on anything ICT. Okay. It's not there. It ain't there. No one gets to say, I helped ICT. You didn't do that. The Lord already did all that. So you ain't getting his glory. The point is this, that high was chosen because just simply roughing it where we were at in proximity to that line, halfway point is somewhere in here visually. I didn't have to draw a line on it. And that high right there just so happens to be perfect. And it's too clean. Clean meaning it's too aligned with where the mid gap would be. Consequent encroachment line is that little one right there. It's one tick above that candlestick's high. That's what I meant by too clean. There's nothing to compare it to over here. There's no other high. You can't say this because we already done that. Okay. So that way you understand what I meant when I said it. So, in and of itself, the market trades higher, goes to that level, and then enters a mess in here. And then on the PM session, I saw some joker leave some comment to him. It's refurbished concepts that can't be scaled. Hey, I made your entire month. If you're lucky working 2 jobs. I made that in one fucking trade, you clown. Using the gradient levels, okay? The gradient levels. What is that? That's this level right here. See that? What's existing here? What do we have in the price action? Markets and consolidation. It's chop. The chop is real. The chop is real. It's real predictable. We're going into the PM session. What time of day is it? Lunch. It's lunch. So it's going to do what? It's going to create a run back to a high that forms at 10 o'clock or a low that forms at 10 o'clock. So we're in consolidation. We had that big pink volume imbalance on the daily chart. We had the complete gap closure. Should it do so, should it aspire to do that, that's always viable. It could potentially go up and close that regular trading hours opening range gap high. And there would be no gap then because where we opened at 9:30 all the way up to there would be a full gap closure. Trading back to the low of the volume imbalance on the daily chart, which is that pink box or red box. Always possible. Now watch what happens. The market's creating this consolidation here. It's stacking up sell side and it's stacking up buy side. The edge is looking for it to try to trade up into that full gap closure. So you know it's going to run this liquidity out. Once it takes that liquidity, lunch macro is going to do what? Pull back in the range that formed from opening, which would be what? Low to open up to take the buy side here. Where can it go to? The low of that volume imbalance on the daily chart, which is that red box. Okay. This could have very easily went all the way up and closed the gap. But what's easier? Is it easier just to get to the low of that volume imbalance on the daily chart or expect it to go all the way up to full gap closure? Obviously, it's just to get above these relative equal highs and get to the low of that volume imbalance. You see that? So time, now bring in time. It's at 11:30 to noon. That starts the lunch macro. It's 2 hours long. So 11:30 to 1:30. You want to block that out. You want to have a real good study and go back through your old data, collect this information. What is it forming between 11:30 in the morning and 1:30 in the afternoon Eastern time? Whatever the low, and let's say it this way. If the market was bullish in the morning session going into noon, okay, well, 11:30 to noon p.m., 12 p.m. Eastern time. If it was bullish prior to that, the lunch macro runs to the low that was formed at 10 o'clock or immediately after 10 o'clock time-wise. Now I'll show it to you like this. Look at it like this way. At 10 o'clock, where's my little vertical line thing at? There. Actually, let's do it this. I'm going to strip everything off the chart. Here's 10 o'clock. And then we're going to delineate macro time for lunch. 11. There you go. We learned anything today? If you learned something, this is the time where you put that little thumbs up. I promise it doesn't make me any more money. It doesn't do anything. It doesn't put any money in my pocket. I promise you, it does not do it. And then 1:30. You guys are stingy on that little bit of That's a currency here, by the way. You don't pay me for anything, but that thumbs up tells me you're getting something from it. I don't see a lot of them, but I got like 100,000 people watching the video or the stream, and there's like 1,000, 2,000 thumbs up. It's really not inspiration for me to come out and do it again. Like I already know this stuff. I don't have to do it, but it's infectious to me. Like I feed off of your excitement, and your excitement is measured by that thumbs up. That thumbs up tells me I like what you're doing, ICT. Keep going. I don't have to come out here if you don't want me to keep doing it. Just don't bother clicking that little thumbs up. It's free to do it. I don't know why you wouldn't do it, but whatever. Here is the macro time. Okay, 10:30 to 1:30. The opening bell at 9:30 was here. There's your price at opening. Okay, so from 9:30 to 11:30 to noon, which is here. So in other words, this is what you want to visualize. Every single day you're doing this. Okay, every day. All you guys that are trying to automate things, I mean, this is like Candyland stuff right here, man. Okay. Now, when you were in school, we had a multiplication table. Okay. There's a vertical axis and a horizontal axis. And if you wanted to find what 9 times 9 is, you find the 9 on the vertical axis and the 9 on the horizontal axis. And you go across the grid until they meet. And you find that it meets at 81. That's weird. That's like the number of PD arrays I have. I did that just to be funny. But he laughs at his own jokes, guy. Well, you're weird. But we have the market run up and get to the bottom of that volume imbalance, right? Remember when we had the pink box up there, the red box? It trades up to there. What is it actually doing still? In and of itself, it's taking out the buy side here. It's doing it to get that buy side and then run where? Why is this a fake out? Why is this a turtle suit? Why did I close my long position and not wait for a full gap closure? You know the trade I shared on X? Yeah. This buy side here, that that buy side's taken by bumping the low of that volume imbalance on the daily chart that we highlighted in red. Once it does that, it's taken the buy side here, it's fully expanded to a premium that's, well, it's sufficient enough. But now we have to ring in time because here we're at that time where it's already ran the liquidity. It's probably made the high of the morning session. Now, lunch macro characteristic is now price, because it's an algorithmically driven delivery mechanism. It's going to go through a procedure like a multiplication table. Okay, now think about it. We're looking at the horizontal side, and now we have to look at the vertical side. What do we have vertically? We have to first start at 10 o'clock. And at 10 o'clock, here is a low here. Where are we at here? I'll have to do it in rays. So it might be a little bit cluttered at first, but just bear with me. Okay, I'll do my best to try to explain it. So here is the low, the first low after 10 o'clock. So right away, that is your objective for the lunch macro. What does that mean? Between 11:30 in the morning to 1:30 in the afternoon, the vertical side of, like, think of this right here. Like, think of this whole business right here is a multiplication table. Okay. And the way the algorithm deals with the data is time. You have to first start with time. Man, I'm giving too much shit today. Too much sauce. Stop them. There's somebody coming to the door. I hear the helicopters. Oh, shit. The suits are coming. Lighten up. We're having fun. It's Friday. The vertical axis here, and then we have the horizontal axis. So we have horizontal is the time because that's the time on our chart. The vertical axis is what? It's the price. Okay. So we're flipping it when we're looking at it algorithmically. When we look at charts, we're looking at it with prices down here and I'm sorry, prices over here and time is down here. But the algorithm's looking back across time to a specific price. So we're finding where two price and a point where 2 points of reference where price and time agree. Time wise, that low is the first low that forms after 10 o'clock. It's going to drop down into that low because the first portion of the day has been going up. So the algorithm does what? It seeks liquidity. It seeks discount. It ain't looking at you and saying, "Oh, look at him, he's got one micro contract on. I'm going for a stop. Son of a bitch. It's time to get even." It doesn't work like that. I never said that, but trolls and goofballs and idiots out there, they like to say that. They take things out of context. It doesn't matter if you have your trade there with a stop. It doesn't matter if you're in a position or not. Somebody has a stop loss right there. And if it's one contract, it doesn't matter because the algorithm is going back there because it's going to do what? It's going to take out the liquidity below that low, that low, that low, that low. It ain't just that low. It's just that's the first low that formed after 10 o'clock. Now, what happens if we have a really long, protracted, stretched out day and it's more like a trending day? Would I use the very first low in that regard? No. In that regard, because it's a trending day, what you're going to do is start at noon to 11:30 in that 30-minute window. As soon as 11:30 starts, for that next 30 minutes, that's your opening range, by the way, for lunch hours. This starts the look back period. And then if this was like a trending day, which is not, this is not a trending day. Nobody can tell me, and nobody would be able to make a case in a courtroom where a jury and a judge would say, yep, this is a trending day. This is consolidation. Okay. If this were not consolidation and we had this long block of price action and it was a straight up day, I would use the very first, like we did it here, it would be the very first low and going backwards in price action, going towards the 10 o'clock, the most prominent low. In that case, it would be this one here for me. That's the one I would use. So the lunch macro would be simply looking for a turtle suit from here down to that low, and I'd be done. And I would wait for the PM session or just be done for the day. But because we're in a big block of price action like this, we had the market run higher. We can then go back to that 10 o'clock. And I've talked about this. This isn't like I'm making it up now. I'm just giving you more information on how you can use a trending day versus a consolidation day, the rules that apply with that, and how the algorithm is going to refer to it. And I did not just make up the 11:30 to 1:30. That's why I told you that's when the lunch is. It's 2 full hours. It's in New York time, 11:30 to 1:30. Because what is 1:30? 1:30 p.m. to 2 o'clock in the evening hours PM session, Eastern time. That's your opening range for PM session. So the lunch macro has to end at 1:30 because what does it start then? The next 30 minutes is your PM session opening range, which sets the stage for your 2 o'clock to close for PM session trading. In and of itself, right now, you know more than 99% of the people out there that trade intraday. Think about that. You endured this boring discussion, okay? I'm not done, by the way, but you've endured something and you've got information given to you now that helps you understand why people lose their ass, why they don't know why the market's going to go where it's going to go next. They have no idea. They have no logic. They have nothing except for whatever the Mickey Mouse shit is that they have in their head or in their charts. But this is the technical science behind it, because whether you believe it or not, these markets are absolutely rigged to the gills. It's 100% manipulated. It's 100% controlled. It's 100% scripted. I could not be able to do what I'm doing if it wasn't like that. And that shouldn't scare you. It shouldn't make you uneasy. You should be thanking. You should be thanking the characteristics that are available looking at price through this lens. When does the low at 10 o'clock here that forms right after 10 o'clock during consolidation day, when does it get hit? Oh, that's funny. Look at that. It runs that low out right before 1:30. That's probably random. That's probably random. It's interesting how everybody around the world came to the consensus that, look, we're all going to buy and sell, and by some strange, weird way, our equal net sum zero game of buying and selling, because there's got to be a buyer and seller for each side. It just so happens the end, when it's dropping, it goes right down to that low, right before the technical time for it to now change its delivery mechanism. Now we're entering the PM session. Convince me otherwise. Have fun at doing that, because it takes more faith to believe the bullshit you think the markets are random and it's all buying selling pressure. It takes more faith to believe that than it's rigged. And why is it I'm bringing out all the science that you can go out and measure all these things and it's there? It's there. Oh my. Oh my. That should be exciting for you, because you don't have to tell me in the world that you're converting to what I teach. You don't have to. Just keep it quiet. It's a secret. It's your secret. Just use it. Make things better for for your family, for your future. You don't have to thank me for it. Trust me, you don't have to. So then what does the market do? It goes into its gyrations. Let me get these lines off because it's accomplished the method. And I'll take that little gray box off too, because we don't need that anymore either. Did you learn something there? Um, all these analogies are starting to make sense. Yep, that's it. And then the PM session here. Okay. So the market runs up, takes out that little pool of liquidity there, and then just goes into, stupid price action where it ain't doing anything. You have now learned more about price action than you would from any other book, any other educator. You won't find it in any other school of thought. It's not in my. It's not in any kind of um, archaic price action theory. Al Brooks doesn't talk about it. Wyckoff doesn't talk about it. Tom Hugard doesn't talk about it. Larry Williams never mentioned. Doesn't even know anything about it. Chris Laurie doesn't know shit about it. Supply and demand never taught it. Online Academy, Trading Academy never touched it. Where'd it come from? Where'd it come from? Here. That's where it came from. That's where it came from. And why he picked me, I don't know, man. But you know, I'm thankful. You should just be thankful that he cared enough to let you know. So anyway, when you look at price like this, look at it like this. Remember when you first looked at the chart like that? You're like, I don't know, man. You're telling me I can make money guessing where these things are going to go next? It's kind of intimidating when you look at it that way, doesn't it? Like it's like, what in the world are you expecting me to do? You think I'm going to be able to determine where these things are going to go? Really? And here I am. I'm telling you what it's going to do over here. This little inefficiency to take out that high before the market even opens. I told you I know where fair value gaps are going to form. I told you that none of these 20-year-olds, 30-year-olds, wherever they are, they're never going to be able to tell you what it's going to do before it does it. Now, they can trade based on the things that's available to you, but that's not all I have. See, I have the unique privilege to know more about these things than all of you will ever learn. I had a question posted to me on X. You know, you, do you remember all the things that I know or that I taught? I don't remember everything I've ever said, because I've said lots of things and I've taught lots of things. And a lot of you think that I'm so organized that I know what video, like Kit has, like, I don't know what he's doing, man. He's got like an index. We're talking about what? Let me go. And it's this video, this episode, this playlist, this minute marker. Like it blows me away that he's got all that stuff. And I have other students that's done the same thing, but I don't have it like that. I just have it in my memory. So I have to recall it from a theory perspective, where not I don't know verbatim what I said in the video. But if you put those Larry Williams videos in front of me, I could tell you verbatim what he's going to say. I listened to him that many times. And I guess it's kind of like that for you. Like, you look at me as your
Larry Williams, I guess, in a way. And I'm not trying to say I'm equal to Larry Williams. Just don't look at it like that. But I'm saying that I have a high regard, even still to this day, for Mr. Williams. I think, I thank him for everything he's ever done because he gave me the direction to pull away from guessing and spend more time studying price. Even though none of the things I'm teaching here, except for what I mentioned earlier in the stream, where he talks about range contraction and expansion, um, I learned that from him. And every time I've ever mentioned it, I've been very honest about where that comes from. Anybody that I ever learned something from, I always give them credit because in this industry, everybody wants to claim they figured it out themselves. I see these people, they're sending me emails all the time. They're leaving comments on my YouTube channel. I figured out your IPTA. I know what you did with your algorithm. I know how you did this. No, you don't. Like, stop. I don't even entertain those things, not to be ignorant or condescending, but none of you know what the fuck you're talking about when you talk that stuff. You don't know. You don't know. Okay. You don't know. You might be getting excited because you're seeing things happening in your understanding, but that's not equal to knowing. That's just you getting familiar with reading price action, and it's exciting. I'm not trying to diminish that, but you ain't figured shit out, okay? Just to be honest, you ain't figured out nothing. But you have lots of things to still learn from me, and it's all for free, okay? And just take your time. There's enough stuff out here on the YouTube channel to make all the bread you'd ever want. There's different ways to apply it, how you can structure it to your time of the day, and I'm sitting here talking to you, and I didn't really complete that discussion that I wanted to have in regards to the setup in the afternoon. Control Z for the win. So we look at the opening range gap. I'll say this and then I'm going to close it. So I highlighted the closing price on Thursday, 4:14 p.m. Eastern time. So that's the regular trading hours opening range gap high. Until we get close to the opening time, like at 9:30 in the morning Eastern time, that's the opening bell. That's the opening range gap, high or low. When we're in close proximity to it being the previous day's settlement on regular trading hours, that's what I have written down on my notepad. Regular trading hours, RTH, ORG, settlement. That's what I have in my notes. It doesn't look like this because when I'm writing it down, as soon as the market closes and it trades to 4:15, or if I come back later in the evening, or if I'm doing something because now I'm a pop and all kinds of things are happening in my world, I may have to get up in the morning early, and the first thing I do is I go and see what the 4:14 p.m. Eastern time settlement price is, and then I note that, and then I'm looking at where price is in relative terms to that price, this price here. If we get close to like 30 minutes before opening bell, around 9 o'clock, I'm looking at where we are at that market price, whatever that is, in deference to where the previous day's regular trading hour settlement price is. So if we're way down here, then right away I can now just label that as it's the high because we're going to open up real low, which is a discount opening range gap. It's discount priced from yesterday's 4:14 p.m. Eastern Time's closing price. Now, if we're opening above this price, then it would be a premium relative. Premium relative to the previous day's settlement at 4:14 p.m. Eastern Time. So premium gap is a higher opening gap than where we settled 4:14 p.m. Eastern Time, and a discount gap is an opening lower than where we settled at 4:14 p.m. Eastern Time. Regardless, once you get the 9:30 opening price, once you get that, let's see how that messed up now. I'm not going to be able to pull that back. I don't know what happens when I do that. But that opening price right there, you drag your fib up to or down to, it doesn't make a difference really because you're just looking for the levels. You're looking for that to occur. And then, see, I done fucked up this chart. Let me see if I can still get it. Second. I don't know why it's doing that. It does this sometimes, and I can't get it back. Oh, I think we may get it now. I'm unable to make any more video recordings on this laptop. I've completely filled it up. So I have to find my way over to Best Buy on Monday and grab another one. And this one will be put out the pasture. So by having that 9:30 opening and measuring with the fib here and dragging it all the way up to 4:14 p.m. Eastern time on Thursday, what we're doing is this. Let's go. It's easier to see on regular trading hours. Here's the gap. We opened up down here. Let me take that vertical line off because it's just delineating the 4:14 time. So from here down to that opening price there at 9:30, that's what I'm putting the fib on. Okay. Once you have that opening range gap graded based on regular trading hours, every one of these gradient levels on the eighths and quarters, that's your order block, that's your breaker, that's your institutional order flow entry drill, that's your propulsion block, that's your reaper, that's your fair value gap, that's your first presented fair value gap. That's all the things that you're looking for. Okay, all that hard stuff of figuring out what order block are you trying to trade off of. What's the fair value gap that you're going to use? What liquidity pool are you going to focus on? All of that goes away when you do this, because now you've created the multiplication table, the schematic based on time and price. This is the part I wanted to hide from all of you for the longest time, because I wanted to secure myself globally as the source of this information, because there's so many bullshit artists out there, so many fucking fraud fucking pieces of shit that literally are out there pretending they figured this shit out. Or they'll say, yeah, this is Wyckoff stuff, but they can't get $5 million out of me because they can't go to Wyckoff's printed work anywhere before 1996. It never exists really in Wyckoff shit. They can't prove that this is anybody else's stuff. It's mine. Now, because I'm globally recognized, I'm a little bit more liberal in what I teach, because behind the paywall, when I was running a mentorship, I had so many fucking clowns out there literally taking this stuff and repackaging it and sending it all over the place. In third world nations, in China, I'm all over the fucking place in China. Like, I'm big deal over in China. But they don't ever mention my name. So there's a whole lot of yahoos over there and also in India that pretend that they found this stuff on their own, or they coded it themselves, right? Some bullshit. But anyway, that's the reason why I was, by the optics, I looked selfish. And admittedly, I was being selfish. And I asked the Lord all the time, I was like, look, you know, I agreed to share this. I agreed to it. But I'm asking you, please don't let these thieves steal the glory that you're supposed to receive. Because when you hear me talk about this stuff, okay, I did not sit down and come up with, look at this strategy here, this. I felt led by him. That's how this worked, okay? Me studying and studying and studying, I couldn't find it. It wasn't in there, like when in my studies. It wasn't until I heard this still quiet little voice that said, look here. When I was at my peak frustrations and I felt like I couldn't get any further in what I understood, I'd be weeping sometimes. That means crying as a man. Okay. I was frustrated. I was losing money. I was losing sleep. I was just a mess. And I just cried out to him. I said, look, I need help because I can't do this. Like, I can't do it. And if you let me learn how to do this and you open my eyes and my understanding to this, I will teach this as a ministry, and I will give you all of the credit. I will give you all the glory, and I will use it as like a footstool to stand up higher so that way people can hear me talk more about you. And I'm not the best ambassador for him. I mess up all the time. Even it's always in these live streams. In my other channel, I never reach for curse words. It never happens. It never happens. But when I'm talking about money, when I'm talking about the fraud that's in this business, and the people and the personalities that come forward, and they take things that they didn't create it, they didn't author it, they don't even make any money with it, but they want to talk about it in hindsight. They want to draw these little supposed boxes of this is the long position, this is the short position. If you're going to go through the whole rigmarole of drawing out those supposed long positions or short positions, just do the entry. Just do it. Who cares if it's a demo? Either you know what you're talking about or you don't. And I'm offended, not because you're not stealing from me. You're really not stealing from me. You're stealing from him. And that's why you're seeing a lot of people around the world that took my stuff. I told you all, when you stole it, you're cursed. You don't realize it. It ain't some voodoo, okay? But you are stealing his glory. And that's what this is all about. It has nothing to do with ICT. It has nothing to do with Michael. It has zero to do with that. Nobody is smart enough to figure this stuff out. Nobody ever was smart enough. And I wasn't smart enough. It had to be gifted to me. And I'm not worthy of it. I'm not. Look at me. Look how I talk. I'm vulgar. But I'm only vulgar when it comes to this because to me, when we're in this climate, in this environment and trading, I'm Elijah. I'm God's troll. I'm going to mock everybody because I know who I have and I know what I got. And there ain't no competition. There ain't one of you out there can come close to me. Not one of you. Not because of me. It's because of who I got behind me. Who's inside me? Who gifted me this? Who tells me what to say when I say it? Listen to that live stream yesterday. I'm talking about something else, and all of a sudden I felt him say this. That's how that worked, folks. That's how the unction comes over top of you. It's just like, say this. And you can see me. I'm doing something, and all of a sudden I'm stopped. Okay, I'm look. It was look here. Talk about that. I know it sounds schizophrenic. It sounds like, oh man, this guy's crazy. Okay, if you want to chalk it up as that, okay, fine. I'm the luckiest schizophrenic there is. I'm the luckiest schizo that teaches the best stuff on earth for free. And I don't want the credit. Now make that make sense. I'll wait. Make it make sense. Because every time I come out here, I'm building an altar. I'm putting 12 stones up. I'm pouring water all around it. I'm slicing up every school of thought as a sacrifice. And I'm calling down fire. And ain't nobody coming close to this. Ain't nobody coming close to this. But in good sport, let me finish my thought and then I'm going to go on because it's time for me to get these puppies in because they've entertained themselves out there long enough. I'm actually surprised they've been so well behaved outside. Usually they're scratching on my doors trying to get back in. Once you have these gradient levels here, okay, from the opening range gap, and you can do this with the new week opening gap. You can do it with the new day opening gap. And what happens if it goes to 24 hours? There won't be any new day opening gap. Right. There'll be new tools I'll teach you that I haven't shared. And I have no intention of teaching until that were to come out. To stop worrying. Okay. I have all kinds of tools. Okay. I have weapons that, trust me, none of this is my best stuff. This is all still elementary stuff. This is low level stuff. But it's useful, right? It helps you, it gives you a context to know what you're looking for. So now watch. We are entering into the lunch macro at 11:30. Okay. And I know that it's likely to draw up into two factors of either it's going to be a full gap closure, which I don't require that to do that. It can trade up to the low of the daily volume imbalance, which is that pink box or red box that we have shaded here. And then the buy side is resting just above here. Okay. So we have buy side here, low of the volume imbalance. So in and of itself, that's enough. So I know it's likely to draw there. I have time to do it because at noon, it kind of finishes the day out. Then we can anticipate that lunch macro, as I just talked about before I got on that rant. So here we have price trade up. We have this single candle. See that right there? That's a buy side imbalance, sell side efficiency. What is it laying on top of? That candle in and of itself is laying on top of this gradient level, 0.375. That validates that as a valid buy side imbalance, sell side efficiency to enter on to get to this liquidity or this volume imbalance on the daily chart and complete the time aspect before we go into the rotation that's seen in the lunch macro that will seek the low at 10 o'clock. Think about what I just explained to you. What's the chances? What's the chances of someone knowing this logic and then seeing it every single day pan out? Think about that. What's the chances of that? What's the chances of us as humans being that lucky, that specific in our guessing? Like, what's the chances of that? It's not probable. There has to be substance. There has to be something behind it. There has to be a catalyst, a framework, a structure, a logic that really exists, and it's not convoluted. It's not contrived. It's not conjecture. It's legitimately there. And if you go back and you look at your price action, and you look at your setups, look at your trades, you'll see why they failed now. And you'll now know why the ones you did take, why they worked. There's nothing apart from these levels in agreement with time and price that I'm going to trade on. You all think it's just cherry picked. You all think that there's something I'm doing, some kind of magic trick. It's just this stuff here. That's all it is. I don't need to guess 15 times and then show you. What am I deleting on X? Find a deleted text or post on tweet on X or Twitter. Come on, find it. I don't delete anything because I don't need to. Whatever I say, I stand by. If it's wrong, it's okay. If it's noteworthy for me to go in and put a post behind it correcting what I said, I'll do that. But I'm not deleting it. I'm not giving you a bullish and a bearish and then delete the other one that's not right. I give you a very specific level. I tell you what I'm focusing on. And what happens? It goes there. And your job is to see, what am I using when I say that? Because I'm giving you all the tools. I'm not going to do your homework for you, though. You need to do that. That's the work. That's the process of you going through it, conditioning yourself to expect it, to anticipate it, not predict it, because that's guessing. Anticipating it, that means you know it's going to happen. There's a big difference there. That's a huge increase in confidence, but not overconfidence. But it's not guessing, and it's certainly not reacting. I'm not reacting to waiting for price to prove to me it wants to get to this level, create this closing basis of an up close candle. Once it does that, that validates it. I'm in the middle of this range. I'm there, and I know it's got unfinished business to get up here. So I can go in there and I can add. I can pyramid when it gives me a cheaper price. And then just shy of 9 grand, bingo, bango, done. And that's just me getting in there dabbling. Just dabbling in the chop that everybody else whines about. Oh, I can't trade in this. Yeah, you can. You can't trade every swing, but you're going to trade everything based on time. Time first, then price. Anybody that tells you otherwise, I promise you this, knows fuck all about trading. They don't know anything about price action. They're just lucky. I've never framed my career around luck. I've always been technically science driven. I've been detail oriented to much the degree it's probably to a fault for most of you when you first come in contact with me, because it's like, this is too complex, too complicated. No, it's not. You want to have it like this, folks. I promise you, you want to have it just like this, because there's no guesswork now. You know when you're going to do something. You know when it's going to happen. You know when it's going to form. You know exactly when the fucking fair value gap is going to form. You know exactly at what fucking price range it's going to form on, because you're looking at these levels. You know exactly what you're expecting. I'm not waking up and thinking, man, I hope I get the right fair value gap today. You get out of here. It's always the right one. Get out of here. Look at what I've been doing for years, man. Years. In the witness of public eye, where I'm weighed in the balances. And guess what? I don't have to delete shit. And I got people coming to me all the time, even while I'm teaching for free, begging me, take my money and let me come and be trained by you. No, no. There's enough on this YouTube channel that you can do so well, man. And you don't need to use a lot of it. Just a couple little things. What makes you determine it's bullish or bearish? What time of the day are you going to trade? What are those characteristics for that time of day? What PD array are you going to use? Are you going to take trades that target inefficiencies? Or are you going to take trades that target old highs or old lows for liquidity purposes? How complex is that? You think that's complicated? Then you can't trade. And that's the reality. Like you can't do it. But anyway, these puppies are trying to get me to believe there's somebody in the backyard, which I'm looking out there. There's nobody there. They bark and go crazy, and they run to the doors, and they're like, "Look, Dad, there's something out here." Usually it's deer and all that, but they just want to come in. They're having separation anxiety. So I'm going to close this one. Wish you all a very pleasant weekend. If you are listening to me over in the Middle East, please be safe. Know that I am praying for your safety and well-being. And it's terrible that it's happening, but just know that majority of us over here in America don't agree with what's going on over there, and we want our boys and ladies to come home safely, and we don't want anything happening to any of you over there as well. So until I talk to you next time,